Hello, good afternoon. Thanks for joining us for this third episode in our 2310 monthly educational webcast series. I know that a bunch of people registered and some of them are planning on watching this on demand later. We're going to have a question and answer session as part of this. If you're watching this on recording and you have a question, feel free to submit it after the fact and we can answer that for you as well. But thank you for joining us today. I'm going to go ahead and get started. So today we're going to take about 23 minutes to hit the financial education topic of the month. This time we're going to look at investing in different economic environments and how to build a portfolio that's robust for those. And we're going to spend most of our time on that. We want to give a brief update on the markets and things like that, where they are today, and then get into the Q&A. We did have a couple questions that were submitted ahead of time, so thank you for doing that. And you have the ability to submit them throughout this. And so there's a Q&A function in your Zoom controls, so just go ahead and put a question in there that you have, and we'll get that answered at the end. Submit it at any time, but we're going to take those at the end. So go ahead and put them in at any time, but expect us to hit those in the last 10 minutes. So with that said, let's get into it. Let's review really quickly the agenda. So 23 minutes on the educational topic. We're going to hit really quickly latest market, health, and economic data, kind of an update there, and then spend most of the time on our topic of the month. And then again, spend 10 minutes, last 10 minutes on Q&A. So getting into it really quick here, year to date, we're looking at the S&P 500 index, which is the largest 500 companies here in the US. What you can see, maybe or not make out from this chart, but we're up now slightly as of yesterday for the year. Pretty remarkable. We saw about a 34% drop in the beginning of the year. So from mid-February to mid-March, roughly 34% drop, and back up 46% from there on the S&P 500 index anyway, which puts us slightly positive for the year, down a bit from the peak in the market, which was late February. Obviously, we're looking at just one index here. This is the S&P 500 again. There's going to be other indexes, other markets around the world, small cap stocks, international stocks, things like that, that are going to have different year-to-date performance. But just honing in on the S&P 500, that's where we are so far year-to-date, which is pretty remarkable given everything that's gone on in 2020 so far. One thing I'll point out, we've looked at this chart before, but how does this 2020 compare to prior years and prior bear markets? We did have a bear market. We were down, as we just looked at, 34% at one point from the peak. That's right in line with an average bear market drop. So I've highlighted that here. And then the recovery of 46% since then, that's actually right in line with an average one-year recovery. Now, the difference would be this is average over 1 year. The 46% recovery that we've seen has actually happened over 4 months. So a much shorter time frame. And obviously the market could go sideways, not go up any the rest of the year. Could go down. Don't know what it's going to do in the short run, but we're basically right at average recovery. So that's one thing I would point out here. The other thing to note here is that's in the green anyway. Over here on the panel on the right is large cap stocks. In gray are small cap stocks. And historically, you've seen a stronger recovery in those in small cap stocks following a bear market than you have large cap stocks. We've not necessarily seen that so far this year. Small cap stocks are up slightly more than large cap stocks. They're up about 50% versus 47. So a slight difference, but not a huge difference. And historically, we've seen small cap stocks do a lot better after a market environment like that. So that's one thing that we're going to continue to watch. So that's where we are from a market perspective. Getting into health data and the economy, other things that are driving the markets. On the health front, I put a new data source here. This is the COVID tracking project. And I like how this lays out basically tests, cases, hospitalizations, and deaths, kind of left to right, and puts it all just kind of on one page. And these are the things that I'm paying attention to, and I think the big picture, kind of what matters from a health standpoint. And the couple things that I'll point out here, obviously, if you've been paying attention to the news, cases are rising substantially and pretty rapidly. where are we today? So the last few days, the number of new cases has started to level off and decline, and you start to see this 7-day average. There's some daily variation in the data, and so 7-day average spreads it out over a week. Started to see this kind of peak and decline. So hopefully that continues. Hospitalizations is going to obviously lag new cases, and then deaths as well. So you've seen less of a substantial spike in terms of deaths versus new cases. Hopefully, obviously, that continues, but this can be lagging on the new cases. So we'll continue to watch this. Obviously, the market's paying attention to what's going on from a health perspective. So that's one thing we need to stay abreast of. The other thing would be the economic data. And so again, we've looked at this chart before here, but basically what we're looking at is the economic data coming in better or worse than expectations? So that's what the Citigroup Economic Surprise Index measures. If you're above 0, the economic data is coming in better than expectations. If it's coming in below 0, the economic data is coming in worse than expectations. And what you can see here, recently, the economic data is coming in much better than expectations. Part of that's because the bar's been pretty low, expectations have been low, but part of that is it's just exceeding the market-wide expectations out there, which is it tends to be a good thing from a market perspective. It's more better or worse than expectations than it is, and from an absolute sense, is the data good or bad? So that's one thing that obviously the markets are paying attention to. We're continuing to watch. It's hard to make out here, but recently the data has been coming in. It's been beating expectations by less than it was previously. Now, it's obviously still very high, but as the bar continues to get higher in terms of what the expectations are, it's going to be much harder and harder to beat. And as you can see with this data set, it does mean revert, or it is very cyclical. For a while, it's going to be beating, and then it's going to not beat. And that makes sense. As the bar gets higher, it becomes harder and harder to beat the expectation. So again, as of now, the economic data continues to come in better than expectations, which is part of what's fueling the markets. The other thing, I don't have a slide for this, but we're into earnings seasons. And so companies, I think Microsoft and Tesla are announcing this evening. The markets are always obviously paying attention to, probably more so, what the earnings and what the forecasts for some of these companies are, given all the uncertainty that's out there right now. So that's another thing that the market's paying attention to. All in, I would say, what matters, and we've looked at this before, what matters to the market is what's the expectations for next year, not necessarily what was happening right now. So the panel on the left plots the S&P 500 return against GDP growth in the current year, and the panel on the right plots that against GDP growth in next year. And so what's much more indicative of market returns is actually what GDP is going to do next year. So if you were able to predict that, that would be much more indicative of what the market returns are going to be or going to do this year. So this is, kind of one of the reasons why the market can be rallying or going up when we are in a recession and we are having a bad economic environment and a bad health situation around the country. So that's kind of it on just the quick check-in. Moving on to our topic of the month, which is building this robust portfolio. We want to dive into 3 pieces of that. So we're big fans of diversification. I would argue if you talk to most portfolio managers or advisors, they're going to advise you to build a diversified portfolio, but there are some drawbacks to that. So we're going to talk about that. We're going to look at some different asset classes in terms of the options you have available to you when building this portfolio, and then dive into kind of 2 rationales for doing this. There's a short-term benefit of diversification, and there's also long-term benefits as well. So kind of looking at both of those and doing all that through the lens of building a portfolio that can survive different economic environments. So first, before we get into that, I thought it might be fun to do a little bit of a pop quiz this time. So I've got a question for you. Go ahead and just kind of jot down your answer, and we'll hit this at the end. And I have no prize, but you get bragging rights if you get this right. So the question is, here in the US anyway, over the 9 decades from 1930 to 1919, or 2019, excuse me, which asset class, and we're just talking about cash, bonds, or stocks, was most consistent in providing positive real returns? Now, real returns are after inflation. So between cash, bonds, and stocks, which asset provided most consistently positive returns over those 9 decades. Now, we're not talking about the highest returns, we're just talking about which was most consistent in providing positive returns. So that's the question, cash, bonds, or stocks. Jot down your answer really quick, and we'll hit that at the end. So we want to get into our topic here, and I wanted to start with a little bit of a story or an example here. What we're looking at is a picture of Ed Thorp. Ed Thorp was a mathematician. He was a mathematics professor, and famously kind of palled around with Claude Shannon, who, if you're an engineer, you probably know the name Claude Shannon. He's a mathematician and invented information theory, kind of a big name out there. But so Ed Thorp was a mathematician. I think he got tired of this salary in academia and decided to take his mathematical talents to Las Vegas, and ended up writing a book, making a bunch of money playing blackjack, 21. Wrote a book called Beat the Dealer, and he basically worked out this system where it's a card counting system, and he, through counting cards, could tell when or predict when the deck was more favorable or less favorable for him as the player, and he was able to tilt the odds in his favor against the house. And basically, when he felt like the deck was in his favor based on his card counting approach, he would vary his bet. So he'd bet more when the odds were in his favor. Obviously, Las Vegas was wise to this. After a while, didn't like that very much, ran him out of town. So he decided then to take basically the same approach to Wall Street. Ended up starting a hedge fund, and a lot of their strategies was around arbitrage. So if one security is overvalued versus undervalued, they were able to, again, calculate the odds, make a bet based on that, and ended up making a lot of money doing that. Now, the world was different back then. This was before computers. A lot of these things, these strategies he was doing are not really possible today, not possible to make a bunch of money doing them because of computers, and it's kind of really easy to do these strategies that he was doing. But he was able to take this mathematical approach that he had of where are the odds, let me vary my bet based on those odds, and do very well for himself. Very interesting character. Wrote a book recently called The Man for All Markets, and chronicles basically his life history, Vegas, on Wall Street, and talks about where he thinks things are today, both from a societal perspective and from a market perspective. So I'd highly recommend that book if you're interested in checking it out. But there's 2 lessons from all this that I think are relevant for today. And one is this notion of playing the odds. That's what he did. That was his methodology, whether it was in blackjack or with a hedge fund, of let me find ways that the odds are in my favor and capitalize on those, or let me find a way to maximize my odds of success. So that was his first step. His second step was don't go broke. He had a system, again, playing cards or in running a hedge fund, where he wouldn't bet at all on a particular outcome. Even though the odds are in his favor, it's not always going to work out every time. And so he had what he called the Kelly criterion, where he would vary his bet based on the odds, but he would only bet a particular percentage of the money he had available to him based on those odds. So he could never go broke, because I think he would never bet more than 50% of his bankroll, essentially. So those 2 things I think are relevant as we talk about building a portfolio that is resilient in a bunch of different economic environments. So we're going to use those 2 points as we look through this. The other thing that I would touch on here is diversification worth it? I think this is a question that tends to come up now after we've had a period of very good returns in the S&P 500 for a long time. And the question is, is it worth doing anything else? Should I just have all my money in the S&P 500? Why own anything else? And the aim of some of these slides is just to show, yeah, it is still worth it. The market has gone through periods like this before, and it will go through periods like that again, but diversification is still worth it. So let's look at those 2 things, the play the odds. So what we're looking at here is, in red, just a plain vanilla 60-40 portfolio. So 60% stocks, 40% bonds, against a more diversified portfolio. So it's still going to have stocks and bonds, but it's going to have different types of stocks, value stocks, international stocks, along with some other things like commodities or real estate investments. What you can see here is the portfolio in green, the more diversified portfolio, the odds are in the favor. It's got the longest drawdown in terms of number of years that it's underwater is lower. And then in terms of the maximum drawdown that portfolio has experienced, about 8% lower in terms of maximum drawdown. So the odds are better for that portfolio. The other thing is, the second step there is don't go broke. This is particularly important when you're pulling money out of your portfolio, when you're retired or withdrawing money for any reason. The more diversified portfolio on average over history has a higher safe withdrawal rate. So the chances that you run out of money by taking the money out of your portfolio are lower, or the other way to look at that is you can pull more out of your portfolio and not run out of money, essentially. So following those two steps. Now, there are obviously some drawbacks of diversification. There's some pros and cons. Pros we just looked at, so you're more likely to make money. On average, it's going to be up more often. It's going to protect your assets. We saw that with the drawdown. And there's a higher withdrawal rate, or the other way to look at that is higher probability of success, higher probability that you don't run out of money. So that's all, kind of tipping the odds in your favor, don't run out of money. The cons are, somebody's always going to be outperforming. If you have a diversified portfolio, you're always going to have some things in there that are doing well, some things that aren't. And if somebody just owns that one asset, or they just own Tesla or Amazon or whatever it is, you're always going to be trailing somebody. You're never going to be at the top. The other part of that is, it's not going to make you rich, at least in the short run. There's no get rich quick component to a diversified portfolio. So when we talk about these trade-offs and building a diversified portfolio, we need to kind of understand what our asset classes are, or what our menu is to build this diversified portfolio. And there's a lot of different options. They fall into three primary buckets here. You either have stocks or bonds, or you have real assets. Real assets are things you can typically touch, feel, and things like that. Within each of these buckets, though, there's a world of different opportunities and different options. And so with stocks, obviously, you can have large companies, medium companies, and small companies. You can have companies in the US, you can have companies outside of the US, you can have emerging market stocks. You can have privately held stocks. So there's a bunch of different opportunities there. Bonds, same thing. You have corporate bonds, government bonds, municipal bonds, which are bonds that are issued by cities or states. And you can have mortgage-backed bonds. Real assets, typically we're talking about things like real estate, houses, buildings, industrial buildings, complexes, things of that nature. Those can be either publicly traded or they can be privately held as well. Commodities, these are things like oil, gold, wheat, etc. And collectibles, or things like that, art, wine, they can make their way into this asset class decision as well. So that's kind of our playing field. We want to then look at kind of different considerations when you think about those different assets, and why it makes sense to have a mix of all of these. So we looked at this, I think a month ago, but one way to look at this is basically a 2x2 matrix. We want to think about inflation and a lack of inflation or deflation. And we want to think about growth in the economy versus an economy that's not growing. And there's going to be different assets, some of them we just looked at, they're going to do better or worse based on those different environments. So I would hone in on kind of this inflation versus disinflation bucket, but cash, because it's a very short-term investment, actually can do okay in an inflationary environment. If interest rates are going up, your cash kind of adjusts to those new interest rates. TIPS, which are inflation protected bonds, essentially, commodities. And then as it relates to the US dollar, which oftentimes can impact inflation, foreign stocks, all else held equal, if the US dollar is depreciating relative to other currencies, foreign stocks should outperform US stocks. In a environment where there's low inflation or disinflation, bonds that have a fixed rate of interest that they're paying, the lower the inflation is, the better off they are. So long-term bonds, corporate bonds, et cetera. And then US equities, at least as it relates to US equities versus foreign equities. So one thing that kind of controls inflation somewhat is the strength of the US dollar. The stronger the US dollar, the less inflation we tend to have here in the US. And under that period, under that kind of setup, US equities, again, all else equal, earnings matter, valuations matter, et cetera. But all else equal, US stocks would do better than international stocks under that situation. That's kind of been the situation we've had for quite a while here in the recent past. Is the dollar's been strong and US equities have outperformed international equities. That's starting to turn so far this year. The US dollar has been selling off and dropping. Subsequently, that's obviously helped international stocks. It's been driving some of the rise of gold and some other commodities. And so that's obviously something that we will continue to watch, but something that impacts the considerations and the necessity to have a mix of these different things that can do better or worse in different economic environments. Now, when we talk about diversification, wanted to touch on kind of two things here. There's, on the benefit side, there's really some short-term benefits and some long-term benefits. I think most of the time we think about these short-term benefits, which are an investment that doesn't necessarily move together. So one investment's up and the other's down, that would be diversification, and some protection in down months. But there's also this longer-term consideration, which is things might move together in the short run. You know, stocks might move together, but over the longer term, they can have vastly different return perspectives. So this is kind of falls into there's always a bull market somewhere, and it makes for a smoother ride. So let's kind of quantify what I'm talking about by these short-term and longer-term benefits. So you can break these asset classes that we're looking at into kind of a high correlation and a low correlation bucket as it relates to stocks. So what we're looking at is a correlation with the S&P 500 index among a bunch of different types of asset classes. So managed futures, bonds, commodities, REITs, hedge funds would all be in the low correlation bucket. They don't move together lockstep on a daily basis. Whereas some of these others, emerging markets, developed markets, small cap stocks, for example, and value stocks, do move more in lockstep day to day with the S&P 500. Now, that said, even with the high correlation, they don't always move together in terms of the magnitude. So here's what we're looking at is when the S&P 500 is down at least 2.5% for a month, how do some of these asset classes hold up? And what you can see is managed futures and bonds, for example, these lower correlated assets actually have had a positive return on average in those scenarios. And some of these other low correlation asset classes have had a lower return, a less negative loss as well, whereas some of these things over here are more or less in line. This is important when you're pulling money out of your portfolio. So we're looking at a sort of hypothetical description here, but as you move into the typical retirement age around 65, having some of these short-term diversifiers, things that aren't down when stocks are down, are important because this is when you begin pulling money out of your portfolio. So there's this getting close to retirement, and then there's the now I'm pulling money out of my retirement. And this matters greatly to have some of that diversification in the portfolio. The other ways to look at this is how much do returns matter in any given year based on when I retire. And what you can see here is going into retirement versus when you retire and start taking money, the returns that you get when you retire and start taking money out are basically about 3 times more important than in any year when you're working, when you're accumulating. And you can't do anything about what the market's going to do in any particular year, but that short-term diversification is necessary and helpful to kind of smooth the ride through this period. And all that leads to basically the higher withdrawal rate that we looked at before. This more diversified portfolio with a smoother ride gives you the ability to pull more out of the portfolio. Moving on quickly to the long-term benefits. We're a little bit crunched on time here. What you can see, this is a recap of the prior chart. These high correlated assets, these different types of stocks here on the right, there's a high correlation, but there's still a long-term benefit. So there's going to be periods. We're going to look at here too from the historical period back to 1970, where the S&P 500 has a long period of time where it doesn't provide a meaningful return. So this is the 70s. So it went a little over 5 years in the 70s with a very low return compared to some of these other asset classes, value stocks, small cap stocks, international, and bonds that actually did pretty well over this period. So this is that long-term diversification. These things might move more or less in lockstep day to day, but over a longer period, you can have a meaningfully different outcome. Same thing in the 2000s. So this is often referred to as the lost decade, which for 10 years, a negative 9% total return for the S&P 500. Hard to imagine based on where we are today, but this is another example of the long-term diversification. There are some other asset classes in here, small cap stocks, emerging market value stocks, for example, that had very good runs over this period. So if you have all your eggs in this basket, you're missing out on a bunch of opportunity. So that's the rationale for the long-term diversification as well in the portfolio. So that's most of the presentation here. So real quick summary is the importance of diversification, playing the odds, and don't go broke. And we kind of looked at data that supports what are your options for diversification, how that improves your odds, and how that minimizes the chance you're going to go broke. I did want to circle back here to our question of the month here. So over the 9 periods, if you want to think back to your answer here, which asset class, cash, bonds, or stocks, was most consistent in providing a positive real return? And if you said stocks, you're right. It's a little bit counterintuitive, but that positive or after inflation return, stocks have actually been more consistent in delivering that. The 2 periods where stocks did not, this was the 70s, a high period of inflation, and then actually that decade that we just looked at, 2000 to 2009, not only did stocks, at least S&P 500, have a negative net return, there was some inflation as well, and it had a negative real return as well. So that's it for the presentation. I know it went a little bit long, but we do have a few minutes, 5 minutes or so for questions. So I haven't seen any come through. If you do have any, go ahead and put them in the Q&A function. We did get a couple with registration, so I'll go ahead and hit those first. First question that we got was around mortgage rates. And so I think this question, the essence of the question was basically, what's our outlook, our forecast for mortgage rates going forward? Now, I would argue, first of all, that it's going to be hard to forecast where mortgage rates are going. I would say, secondly, the Federal Reserve is basically doing everything in their power to keep interest rates low, and mortgage rates tend to be most tied to the 10-year Treasury. So if you're trying to pay attention to where mortgage rates are going, if you look at the 10-year Treasury and where the rates are on that, that should give you a pretty good indication. Now, again, hard to predict where that's going to be in the future, but the one thing I would say is the Fed has been doing as much as they can to keep rates low. We talked last time about inflation and some of the headwinds to inflation. So there's definitely some factors that are out there to keep rates low. The one thing, if we're thinking about mortgage rates, you're probably either looking at refinancing or purchasing. And so some of this comes down to individual assessment of what's right for you. Scott Malbassa, who's one of the advisors at Cordant, actually put a blog post up recently, which was titled, "Does it make sense to refinance my mortgage?" So if you want to go out there and read that, it might give you a pretty good, if you're thinking about refinancing, that might give a pretty good playbook. But basically, what he suggests you do is determine your long-term objective. How long are you going to be in the house? Things like that. Calculate what you're going to gain by refinancing, look at the costs, and then calculate the break even. So that might be one framework. Rates could go lower, sure, but does it make sense now would be one thing to look at. The other question that came in with registration was also related to rates. The question is, in the current climate of low interest rates, how to factor in bond allocations. So another way to look at that is, does it make sense to have an allocation to bonds based on where interest rates are? So again, one thing that I would suggest here is that it's going to be pretty hard to predict where rates are going. I think nobody can accurately forecast interest rates. It's probably one of the hardest things to do out there, and people have been trying to do it forever, and it's difficult to do. But one thing I would think about is inflation. So we talked about real returns, the returns on your asset versus what inflation is providing. And if we remain in this low interest rate period, like the question suggests, the question would be, what's inflation doing? So if we remain in a low interest rate period, inflation is probably low. So you could imagine a world where historically bonds have returned 5 or 6%, and inflation has been around 4%. So a real return of 1 to 2%. Well, if we have low rates and if inflation is low, so say we have 0 to 1% inflation, if you're getting 2%, 3% on your bonds, you're still getting that kind of 1 to 2% real return on that asset. So that would be one thing to think about, is even though kind of the sticker price is less in terms of the yield you're getting, what really matters is how much above inflation, how much are you outpacing the price of goods increasing, are you getting? And if it's still that 1% to 2% above inflation, even though the coupon looks different, you're still getting the same real return. So that would be one consideration. The other consideration is kind of as a necessary evil. Unless you're early in your career, willing to put all your money into stocks, can afford to do all your money into stocks, they're one of the only options out there that's kind of consistent and reliable hedge against market drops like we saw this year. So there's a necessity to have there. Now, if you are somebody that's more comfortable with risk, more comfortable with drawdowns, maybe further from retirement, yeah, this could be an opportunity to get a little bit more aggressive with your portfolio. But the bonds in your portfolio as a way to stabilize the ride, increase that withdrawal rate around that retirement period, I would argue is still important. But yeah, it's a very good question. We did have one question come in here live, and basically the question is, how do you determine the percentage of different asset classes when constructing the portfolio? So this is a tricky question. This is one that I would say is going to be individual per person and based on your circumstances. And so this framework that Scott laid out as it relates to refinancing actually is a pretty reasonable framework for doing this as well. So think about your long-term objectives. What are you trying to accomplish? What are your goals? What's the cash flow that you have coming in? What's the cash flow that you have coming out? And that's largely going to determine your risk tolerance. So there's going to be a couple factors there. There's going to be your tolerance for risk just as an individual. This is kind of the sleep at night factor. And then there's going to be your financial ability to take risk. So how much do you need to withdraw from the portfolio, or are you contributing to the portfolio? How stable is your income? Are you somebody that has a pretty stable career and income? Think historically like the tenured professor, or are you an entrepreneur where you're basically living and dying by the success of your business, and the income can vary wildly year to year. So that would be kind of one factor as you think about how much risk to take on. And then kind of the starting spot is 20% bonds and 80% in stocks. Or maybe even a little bit more for somebody that's very aggressive, and then all the way down to, maybe 20% in stocks and 80% in bonds as kind of the spectrum. And I can follow up with you if you like on basically different portfolios, again, just kind of the plain vanilla portfolios of each of these, but where they fall in terms of the return and the risk of each of those. But first step is kind of what's your objectives. Second step is what's your risk tolerance. Third would be, where on that spectrum do you want to be? Where are you comfortable between all stocks and all bonds, say, for the risk you want to take on? And then last step is to tweak it from there based on some of these additional diversifiers that you can add into the portfolio that we looked at. So maybe, sprinkling in international stocks or value stocks or different types of bonds, things like that. So hopefully that helps. And I can reach out if needed on kind of what that looks like across the spectrum. So that's it for questions, and that puts us 2 minutes over time. So appreciate everybody joining us today. Hopefully this was helpful. And again, love any feedback that anybody has, topics that you'd like us to address, or any other feedback on these. We plan on doing these monthly. We want them to be helpful. So please provide us feedback to the extent that it's helpful. And then last thing I'll mention is we do have a page here, cordantwealth.com/23-10, that the recording of this will be available if you want to check that out as well. So that's it. Thanks for attending, and we will talk to you next time. Thanks.